We need to think about how do we embrace more to bring on better human capital in specific verticals. Once we do that, once we have that ability, we are going to be able to execute and respond to the needs of our builders and our users much more effectively, right? We're not going to be pulled in a million different directions. If we want to think about how do we help grow the DeFi category, what can we offer to early stage projects that we don't offer today to make them embrace Arbitrum? How can we do all of these things? When we have people who it's their authority, mandate, responsibility, and they have funding to do those things, the operational efficiencies will go through the roof.
Hey everyone, quick shout out to today's sponsor, Namada. Namada is currently entering phase 3 of their mainnet rollout, so make sure you check it out by following the link in today's show notes. We'll talk more about Namada later today, but for now, let's get started. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. Hey everyone, this episode of Bell Curve is a crossover with Expansion. This week, we were joined by AJ Warner, the CSO of Offchain Labs, to discuss his vision for Arbitrum as a digital sovereign nation, Arbitrum's business model, and how the new OpCo structure will drive operational efficiency. Enjoy. All right, everyone, welcome back to another episode of Expansion. Today, I'm joined by AJ Warner, Chief Strategy Officer at Offchain Labs. AJ, welcome, man.
Hey, Michael, thanks for having me. I really appreciate it.
Me too, man. I'm really excited. We've got a lot to discuss here today, and I'm pumped about this because I think there's going to be a little something for everyone in this episode. We're going to be talking about this very bold and ambitious vision that you're unveiling for the Arbitrum DAO today. And there's some I think you've done some very interesting work, and I had a lot of aha moments reading your own personal take on just how to think about L2s versus L1s and this strategy for how you're viewing Arbitrum on a long-term basis. And then there's also a real mechanical shift, which is going to operationalize that vision in a super interesting way as well. And I would love to start first with the fun stuff, kind of the long-term vision. And you wrote this post on X last week, talking about Arbitrum as a sovereign digital nation. And I want to get to that part of the vision, but before we get there, can you kind of just give us a state of the union about, there's a long discussion, including myself, I've had it on this podcast, about how to think about L1s versus L2s and how should we categorize these different things, these protocols. So can we just start there, and how do you think about those two differently?
Yeah, no, 100%. So I think it's a really interesting and smart place to start, because I think a lot of the conversation is actually going to flow from those differences and what DAOs and communities and ecosystems can do as a function of the economics of these ecosystems. But the place to start is, obviously, I think in many ways, and even if you look at like Arbitrum chains, like people like to say, I can't remember who coined it, it's chains and bridges in some ways, right? And different blockchains, depending on their architecture, have different setups. And Arbitrum, to the average user, and this is the way it should be, and even the average developer, it doesn't really matter that much that it's an L2 versus an L1. It looks like a blockchain, it acts like a blockchain, it feels like a blockchain. We can talk about like fragmentation of liquidity on those kind of things, which a million people talk about. But fundamentally, like L1s and L2s both fragment liquidity across a world where there's hundreds of chains that exist. There are some big differences, though, between L1s and L2s from my perspective, in terms of how to think about them from an economic perspective. When you look at L1s, and this is true largely of all the major ones, Ethereum, Solana, Sui, Aptos, anything that basically operates on a proof of stake model, part of that fundamental vision is that you have people that stake with validators, or they delegate to somebody else who's going to stake on their behalf, and they're earning some form of yield on behalf of that. In Ethereum, basically the overwhelming majority of that yield comes from transaction fees. Some of it gets burned, some of it doesn't. You might be slightly inflationary, slightly disinflationary, but the general thesis and point is that the transaction fees that are generated by the protocol flow directly to the stakers of that protocol. And that's because it's really important for security purposes that you have people that are going to be staking and validating the network and are rewarded for doing so. The effects of that, though, are that the protocol doesn't actually retain any of its income or revenues in any meaningful way. So the way that they typically and historically have grown is that they have a foundation that operates alongside it, or there's aligned organizations and entities that are focused on the growth of the blockchain, essentially. But they also don't have governance. Some people in many ways view that as a positive, because if you want to have a fork, instead of relying on a governance vote, you can rely on sort of the validators to execute that. But they don't have sort of this concept of a DAO governed treasury in the sense that an L2 can have. I'll talk about L2s, and then I'll talk specifically about Arbitrum. But the key thing about an L2, and what makes it unique, especially, we'll talk about L2s that settle to Ethereum, is that they derive their security from Ethereum. So that's true both for ZK rollups and optimistic rollups, Arbitrum being an optimistic rollup. And what I mean by they derive their security from Ethereum is that they don't have their own validator set. The validator set that is adjudicating the finality of transactions is the Ethereum set of validators. And Arbitrum and other L2s pay Ethereum for that security. There's obviously a ton of conversations in the ecosystem right now of whether L2s are sufficiently paying enough to Ethereum or they're not sufficiently paying enough. I think that's orthogonal to the conversation. But what it does allow is that today L2 transaction fees are basically 90% plus gross profit margin businesses. They don't need to distribute to token holders, stakers, validators the same way that an L1 does. And then in many ways, to me, the question of whether an L2 should or should not be returning funds to token holders in the form of transaction fees is a function of whether you have a better thing to do with them in the form of reinvestment and growth. And in Arbitrum's case, I think that that's really important, and the answer is a resounding yes, and we'll talk about that in a little bit. But this difference between L2s and L1s is largely a function of this, and I think it opens a huge space for L2s to have a lot more creativity and ambition in what they want to accomplish that is owned by the token holders than an L1 does. And if you just think about sort of, investment and valuations and the economics of this, if you're not doing something like this and you're not reinvesting in growth, the opportunity costs for L2s versus L1s is actually a really bad value proposition for an L2. Because if Sui or Solana are paying 10 or 8% to stake their token and there's no mechanism to do that on an L2, then why would sort of your prioritization as a capital allocator be to hold an L2 asset? And the answer must be either that the transaction fees are more and they're returned, or that you believe in its ability to reinvest and return to the token holders ultimately. And that, I think, is very much the vision of what I'm trying to build with Arbitrum as a digital sovereign nation. And how I think sort of that vision comes to life. And we'll talk about it more, I'm sure, down the podcast, is how do we make sure that we can accrue value that goes to token holders? And the big thing that makes Arbitrum unique here, that makes this vision work, is the community's ownership of its assets. Because the whole thing doesn't work unless the actual value accrues back to token holders. So when we sort of decentralized Arbitrum as a protocol, we gave the Arbitrum community and token holders authority of the assets and authority over the technology. What I mean by that is all network fees, all transaction fees, they accrue on-chain to the token holders. You can't get the funds out of the treasury without a vote of the token holders. Any protocol changes about increasing the amount of revenue or fees that you want to charge users to use the network, all of these things are controlled by the token holders. And it's really important because now you have that authority upon which you can build what I call business units on top of it and continue to reinvest. And there's a dual mandate there that I think is really critical. The dual mandate is, how do we make sure we can continue to invest to support builders? And how can we do it sustainably? And how do we also make money? So it's invest in builders and also make money for the DAO. And the reason those things are really important, it's because that will continue to compound and continue to grow the vision that we're trying to accomplish. Because without that, I think it's much more challenging to understand what is the long-term ambition of what we're trying to accomplish beyond just providing scalable blockchain resources to people.
This episode is brought to you by Namada. Namada is the shielded asset hub rewarding you for protecting the multi-chain. Shield your data across any asset and any chain and get shielding rewards for helping strengthen data protection for everyone. To learn more, follow the link in the description below. Today's episode is brought to you by Ledger, the global leader in digital asset security. Celebrating 10 years of innovation, Ledger is trusted by 7 million users, secures 20% of the world's digital assets, and remains the most secure hardware wallet for your crypto and logins. Follow the link in this episode's show notes to grab your Ledger today. There's a lot there, AJ. I want to unpack. I want to actually return to something that you said at the beginning, a key difference between L2s and L1s being this ability to allocate capital. And this was actually a big realization that I had when I was thinking about originally trying to reason about L1s and how to view the token. And this is why for a long time I've come to the conclusion that these things are mostly commodities because you're lacking this. And actually there's a great chart, a guy named, oh my gosh, I'm blanking on his last name. Julian from head of macro at Fidelity Digital Assets. He showed me this chart of returns of different asset classes going back in the late 1700s. And you've got equities, bonds, yield-bearing cash, gold, precious metals, and equities clobbers everything else. And the reason for that is because you can compound capital. So you can take capital and then you can reinvest it into the places where there are the highest returns. And so equities over time just dominates everything. It was a huge light bulb moment for me because I realized at that time that L1s do not have the ability to do that, right? There's no coordinating entity.
Yes.
And at the L2 layer, what I heard you say is actually that's a massive advantage. There are some advantages right on the L1 side of things of being incredibly neutral, and there's actually a design decision of Ethereum as opposed to something like Atom, which actually does have some sort of treasury to not allocate that, right? That's why they just burn that those funds. But yeah, I mean, it's a really exciting opportunity for L2s in general as being an allocator of capital.
It's an absolute superpower. And I think that I think part of this is that, there's so many L2s and a lot of them have different visions and maybe they have different mandates. Like Arbitrum, I think, and we can talk about how I think about that mandate in a second, but it's one of the biggest challenges of the L1 business model because the industry hasn't been around long enough, in my opinion, to see it play out. But what happens is basically every L1 and historically almost every L2 and even Arbitrum largely, the way that they're funding growth is through inflation of the supply of their native token assets, right? And in Arbitrum's case, the way I view that is just because that's what you do when you're early stage and as you're growing and building. And I actually don't think it's a bad thing. I think that it's two sides of the same coin. Some people will say it's reinvestment and some people will say it's inflation. And the delta is a function of how much you believe in the growth story, right? If you don't believe in the growth story, you call it inflation. If you believe in the growth story, you call it reinvestment. But L1s don't naturally have that mechanism because, one of the things I did in the piece was I compared it to like a REIT. And I'm a former real estate finance lawyer, so maybe that's part of the reason. But in reality, most REITs, they have to, by tax code, pass through, I think it's like 90% of income to holders. That's why REITs pay out huge dividends and they get tax advantaged structures. But when they want to grow, they have to raise new capital and issue new shares, right? And if you're an L1, you don't have that mechanism unless you're going to continue to tap into sort of an existing issuance supply over a 1 year, 5 year, 10-year horizon. That works. But if the foundations don't have mechanisms to earn additional capital in the future, it actually eventually has to sort of run out. Like it's just the law of physics in some ways, right? So I do think though that there are some well-resourced foundations that are figuring out solutions to this, whether that's adjacent products or sub products that they build. But I think it's a fundamental distinction that L2s have as a benefit over L1s.
Okay, and the analogy, so if the analogy that you use for L1s is REITs, where you have to pass through most of the income as dividends, which is the MEV, the REV, right, that you see get passed
Yeah.
through to, and plus inflation rewards that you see get passed to L1 stakers. L2s, the analogy that you used actually was like an oil-rich nation,
Yep.
right, where you had a very high gross margin commodity, and then
Yep.
you reinvested the gains there into demand, something things
Exactly.
will drive demand. So break down that analogy, because I could see a lot of analogies here. One more like an investment management company or something like that. You chose digital sovereign nation. So why that
Yeah,
analogy?
and the reason I chose that is because, when you think about sort of commodity rich countries, jurisdictions, whatever it is, the thing that they have is they have there's a lot of oil in the world, but the reason why it's like Dubai and Saudi Arabia make a lot of money off of it is because their ability to extract it from the earth is cheaper than everyone else, right? So if you have a commoditized asset and it's cheaper for you to provide it to the world, then you will make more money. And when you think about sort of Arbitrum and the way we've designed it, and this is a critical input into the design decision around sort of the Orbit product strategy, which is our ability to launch chains, it is extremely easy and cost effective for us to have the demand for our block space continue to grow and grow. And I like to say that I think, Arbitrum has the best execution environments as a product. And that is our oil, right? And when, when I look at if you take Dubai for a second, people don't say, oh, Dubai is an incredible example of like economic prosperity as a function of the fact that they sell a lot of oil. They sell a lot of oil, and then they've managed to turn that into real estate and other forms of investment that is bootstrapped off of the fact that they have that ability to sell a lot of oil. And for me, that's like a completely different perspective in how I think about block space. It means that block space for an L2, as you grow your profit margins and as you grow the amount of cash that's flowing into your treasury, L2s are not selling block space as an end in itself. They're selling block space as a means to what I call expand their economic zones of opportunity. And those economic zones of opportunity are the builders that are using this technology, the consumers that are using this technology, and finding ways to support them and finding ways to make sure that you not only can do that sustainably, but you can also generate revenue off of it. One example of this, I think, is actually like the GCP, the Gaming Catalyst program. And I think it's a really interesting case study on how to think about this. Let's just assume there's a lot of people who think like Web3 gaming sucks, it's never going to work. But let's just assume for argument's sake that it's a good idea to invest in gaming. I personally think it is. I think that like gaming and finance are the two verticals right now that can bring in tens of millions of users and billions of dollars into crypto, like net new. So let's just assume that that's the case for the sake of this argument. There is no world in which gaming being successful is going to be like you're generating tons and tons of transaction fees. And the reason for that is because there's nobody in this product cycle that wants to pay a lot of transaction fees. Like gaming chains are launching their own chains using Orbit. And I think we have almost 24 today, precisely because they don't want transaction fees to be high. They don't want noisy neighbors. They don't want MEV. They want to abstract it from their users. So they just basically like almost wish it didn't exist. Right. So if I'm Arbitrum and I want to invest in this category, I have two options. I either don't do it in a sustainable fashion, or I insist that transaction fees are implemented into the user product in order to be able to make money off of that. But like neither of those are optimal. To me, the optimal mechanism to do that is actually, and it goes back to what I mean by expanding economic zones of opportunity. If we have hundreds and hundreds of games using Arbitrum, and we have a pool of capital managed by competent people who know the space and know the industry, and they can pick, we want to invest in this game. All of these chains and ecosystems would love to align with Arbitrum. They would love to take that capital and help grow it. And the only way to make money in gaming, and this is true of Web2 gaming and Web3 gaming, is like marketplaces, in-app purchases, and economies. So why shouldn't Arbitrum's business model be flexible enough to ensure that we can earn off of that. So the reason why block space is important is because if they're not using Arbitrum from a block space perspective, they're not going to want to work with you across these other dimensions at the application layer. It's like, if you don't need oil, there's no reason for you to talk to the sovereign wealth funds in Dubai and Saudi Arabia. But if oil is critical to your business and you're trying to find ways to align with these suppliers of oil, they become really critical partners in your path for growth. And that's what I mean by turning Arbitrum into a digital sovereign nation. I want Arbitrum as a partner for all of these builders and all these developers to be a critical partner in their paths to growth and success because they're using Arbitrum as a technology.
Okay, let's talk a little bit about business model here. You outlined some of this in your article, and you talked about a couple of critical success metrics or factors that you could look at, including stablecoin, DEX volume, etc. Can you can you compare the business model here of kind of the Orbit stack plus Arbitrum One compared to something like, I think you were alluding maybe to Optimism's business model in your post, which looks a little bit more like a bundle to me, and maybe some of the challenges there, like pros and cons. Like, could you just kind of outline the business model of Arbitrum today?
Yeah. There's actually like a really, I think, been a huge, Optimism and Arbitrum, I think, is like one of those like competitions for like the last 5 years that everyone in crypto is sort of like
Red Sox, Yankees.
Exactly. Like it's but what's actually been interesting, I think, is there's been a very significant divergence in the last 12 to 18 months in terms of how we think about this. And, I'd obviously love their perspective. I've done a podcast actually with Ryan Wyatt from them in which we like kind of went back and forth on like some of these distinctions. The way I personally view Optimism's business model and strategy is they're much more focused on horizontal scaling and uniformity of the superchain, and their business model being layered around transaction fees that they can earn as a function of the value proposition of interoperability, right? And that's like the model. And in that model, the end state is having more block space for the purposes of generating more transaction fees. In that model, though, the downside is that it's much more restrictive and constrained in terms of like what you can do with the abundance of block space. So for me, if somebody wants to launch an L3 on top of Base, or if somebody wants to launch an L2 on top of Ethereum, or an L3 on top of Arbitrum One, if they're using my technology and they're really good builders, I want to find ways to be supportive of them because I view block space as an end in itself to be a business partner, right? For them, they need you to sort of join this, governed by the OP stack superchain thing in order for their business model to be successful, right? So again, even though the stack might be open source and you can launch like OPBNB, it's actually not relevant and it's not something that they're going to invest in and support per se because it's exogenous to the business model. And the downstream effects of this are, I think, sort of how widespread you might see people taking the stack. So recently, for example, on the Orbit stack, one of the most in-demand features we have is custom gas fee tokens. And the reason for that is because a lot of people want like utility for their token or as an easier experience for like abstracting fees away or subsidizing fees on behalf of users. So when we have like 100 Orbit chains, I think like 75 of them are using custom gas fee tokens. And I think it's a great feature because I want builders to do whatever they think will make their product more successful. OP deprecated it. And the reason for that is, I think, because it doesn't fit well within the superchain. It just adds unnecessarily complex components. So I think their business models become much more about maximizing transaction fees and less about what's happening at the application layer of these, right? So they've done a really good job sort of getting distribution partners like Coinbase and I guess like Kraken and Uniswap, for example. But at the application layer, there's less of a connection, I would say, between Optimism and like an application deployer on Base, for example, because Coinbase is their primary sort of chain relationship. For us, though, who's building on these things is like super important to me, because if I can then align with them, like they're using technology, they love using Arbitrum, that's like ideal for me, right? So when we had, for example, GDC, the Gaming Developer Conference was last month, we had a booth there, and some of the games were building on Arbitrum One, but like other side was there building on ApeChain. And we had games that were building on top of Xi, and Proof of Play is building its own orbit chain. And for me, finding ways to invest and align with all of these chains at the application layer, get them exposure, are critical components in this broader vision of, yes, like I want to make sure you consume our block space, but not as an end itself, but as a means to a broader end. In terms of specifics of the economics, there's also some differences that sort of map into this. One is, so for Optimism, in order to use the technology stack, it's open source, but in order to join the super chain, it's much more restrictive. Like OP will govern your upgrades and security of your chain, and you have certain, like, you can't use custom gas tokens, for example. On Arbitrum, if you want to settle to Arbitrum 1, it's free. You don't have to pay anything. But if you want to use the technology stack anywhere, you give 10% of your profits. But you can do whatever you want. Because if you want to use custom gas tokens, you want to add, if you're an RWA issuer, you want to add KYC and compliance into your node software like Kinto and Rails are doing. Like whatever you're doing, you can do with the stack, because we want to make sure from a product perspective, you're enabling it to be as successful as possible for us to find opportunities to continue to reinvest.
Okay. So that exactly that breakdown, you'd be maybe happy to know, AJ. We talked about this on Expansion with Jill and Uma maybe a week or two ago, and they basically said exactly what you just described as a divergence in the value proposition between the two business models and for different builders. So very cool. I think it's kind of feels more like a complementary set of offerings.
Yeah, I think it's interesting to see how that sort of evolved, and Jill and Uma are fantastic. I think they're both in positions to really see these distinctions in business models. Obviously, like Succinct and Espresso.
Namada is the shielded asset hub rewarding you to protect the multi-chain. Built to give you full control over sharing your personal information, Namada brings data protection to existing assets, applications, and networks. Namada ends the era of transparency by default, enabling shielded transfers and shielded cross-chain actions to protect your data even when interacting with transparent chains. Namada also introduces a novel shielding rewards system. By holding your assets in the shielded set, you help strengthen Namada's data protection guarantees and collect NAM rewards in return. To learn more about Namada, follow the link in the description below. Ledger is the global leader in digital asset security, trusted by 7 million users and securing 20% of the world's digital assets. In recent years, Ledger has built a comprehensive ecosystem of products and services, making digital ownership more secure and accessible for everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, introduced the world's first secure touchscreens, making it easier and safer to manage your assets. Alongside Ledger Stacks and Ledger Flex, they have also launched the Ledger Security Key app, offering a safer alternative to traditional password management. Follow the link in today's show notes to get started with Ledger today.
Well, it's good to hear that you validated our speculation on the roundup, so that's great. But yeah, I think that's cool to see, like, the very complementary kind of sets of offerings. So can you walk us through maybe just some of the maybe to round out the sort of the end of your post here and the conclusion, and then what I want to do is get the connective tissue towards how your particular vision for Arbitrum dovetails with this change in the operational setup that we're introducing to the DAO. So can you kind of land the plane on just like what are some of the metrics that you looked at historically, stablecoin issuance, DEX volumes, that sort of thing, and then help us land the plane on this part of the vision, then we'll get into what we're actually changing here.
Yeah. So the way I think about this on this part of the vision and how we can make sure, and again, Arbitrum is not perfect. I think there's certainly categories that Arbitrum can improve significantly on. Like one I think is in particular is on the consumer side and some of the early stage speculative, creative experimentation that you might see in crypto. I think like Solana's done a really good job with that. I think Base has done a pretty good job with that as well. I think that's certainly an area the Arbitrum ecosystem community and all of us could improve on. But when I think about Arbitrum as a product and the demand for it as a product, I think about Arbitrum 1 and Arbitrum Orbit. And I had this section of the, and I don't think most people understood it, so it probably wasn't written well. When people ask me like what Arbitrum is, historically, the first thing I would say was it was layer 2 on top of Ethereum. And I think that like others who are building their own chains will be like, oh, it's a stack that we can use to launch a blockchain. And it actually, Arbitrum, I think, is neither, and it's actually both. And when I say it's both, I mean that Arbitrum, the goal of Arbitrum from a product perspective is what is the best execution environments we can offer for your stated purpose. So if you want your own chain, like Arbitrum Orbit should be the best thing for you to launch your own chain. And if you want to be on a public chain, Arbitrum One should be the most liquid, credibly neutral, secure, and decentralized environment for you to be able to do that. And to me, it's a complementary product because people are going to go in their journey and start on Arbitrum One and then move to an Orbit. And the things that I look at to see if Arbitrum One is succeeding on those dimensions is things that make sense to be on public chains. And obviously, I think the overwhelming majority of DEX volume trading is going to happen on a public chain. I think the overwhelming majority of lending activity on like something like Aave or Fluid or Compound is going to happen on a public chain. And that's why like I track these things. So, people, there's often like a joke that like Arbitrum is like the hyperliquid bridge. I'm sure you've seen that. I think every blockchain would love to be Hyperliquid's bridge, right? People like to point to it as a joke.
Yeah.
But when I think about Arbitrum as a product, that's actually amazing. Like Hyperliquid, like Jeff Julian, they chose Arbitrum because for them, they wanted to source liquidity from what they believed was the best liquid, credibly neutral, secure, and decentralized environment. And that for them was Arbitrum, right? So when USDT Zero says we want to launch an interoperable version of USDT that can be everywhere, and we need a hub, an economic hub, and they chose Arbitrum, that to me is the role of Arbitrum. What are things that should be on these public environments? Secure, credibly neutral, decentralized, and liquid. So when I look at sort of Arbitrum outside of Ethereum being the leader in Uniswap DEX volume, that to me is a very strong signal, right? Unincentivized Aave, very strong signal, because that means we're satisfying what we're trying to accomplish on the Arbitrum One barbell side of the barbell of the strategy. And then when I see the growth of orbits, and again, I think that like some of the sexier orbit chain names are probably using the LP stack still, but Arbitrum is enabling hundreds and hundreds and hundreds of chains. I don't view them as chains. I view them as opportunities to align with builders and developers. And we're seeing tons of experimentation with AI, tons of experimentation with advanced DeFi strategies, gaming, etc. So that's what I mean by like this strategy of working. The reason why I say Arbitrum is neither a blockchain or a stack is because of what we've been discussing to date. It's a very incomplete version of the story. Arbitrum is the collection of stakeholders that have the ability to invest, grow, and build out everything that's on top of these. So when I want people to think about Arbitrum, the same way that when you think about Dubai, the first thing that comes to your mind is not oil. It's that it's an incredible environment to find liquidity. It's an incredible environment to find business leaders, etc. That's what I want on a digital level, Arbitrum to be. That collection of builders that are tied together, not by geographical space, but by an alignment about this vision of what we're propelling forward. And that doesn't involve, per se, block space. It's a function of that being the input that allows the rest of the engine to operate. Does that make sense?
It does. And here, one question that I have for you, maybe we can now dovetail into, this idea of the OpCo and maybe who the stakeholders are in the Arbitrum ecosystem today. Here's a question that I would ask you, because I really like this framing of being an allocator of capital. And maybe one, if I was trying to play devil's advocate here or come up with a little bit of pushback, would be, originally the investors in Arbitrum allocated capital because, we think you guys are great, however you want it, like harvesters of the Ethereum block space, and, builders of technology in general, like builders of the Arbitrum One and the stack, et cetera. And this actually, the competency shift here a little bit is to be allocators of capital into different sectors or businesses, et cetera. So, what would you, or do you disagree with that framing, or what?
I understand the question, but I understand the question, but I'll explain to you why I disagree with it in some sense.
Okay.
So like I said, when Arbitrum started, it was a technology stack. It was an L2 scaling solution to scale Ethereum. Mm-hmm. And I think, Offchain Labs, and then obviously now that's the DAO with Offchain Labs being sort of like a core developer, has, I think, delivered on that mandated mission, right? And the reason why I'm not advocating that Offchain Labs should pivot from being the developers of this or even take on a second role to now be capital allocators on behalf of the DAO. I actually think that's a mistake. And the reason why we have built this structure where, like I said in the beginning, the authority of assets and control of the purse sits with the DAO, because there are entities and organizations that could be formed that are much more competent for these complementary things in the ecosystem than Offchain Labs could ever be, right? So I'm not here advocating or recommending that Offchain Labs should say, Arbitrum DAO, give us the treasury, let us allocate this and become capital allocators. What I would recommend, and we've seen early versions of this with the GCP and with STEP to some degree, and we'll talk about why to some degree in a second, is I would love if there were more organizations and entities that were working for the Arbitrum DAO in complementary roles to what we're doing. Offchain Labs is really good at product research and engineering, and to some degree also business development for growing people to bring them into the Arbitrum ecosystem. I'm not a capital allocator, and that's not my strength. And we should find people who will be joining the Arbitrum ecosystem. And what I call like this concept of an Arbitrum aligned entity has three main prongs. One, you have to be competent to do the role. Arbitrum success should be mission critical to your success, and you should be focused on winning at the vertical that you're doing, right? So Arbitrum as a concept might become a capital allocator, but that's because the original mandate of Offchain Labs, I think, is leaving the majority, the overwhelming majority of chips on the table in terms of how Arbitrum could capitalize off of it, right? So again, it's not about a pivot. It's about an extension of how do we continue to generate and capture value as a function of the genesis kernel of what Arbitrum was, which is a really good execution environment. So when Offchain Labs contributes its components as a core developer, our goal is to make the oil in this as easy to get out of the ground and have as much demand for its consumption as possible. Arbitrum everywhere, because if Arbitrum is everywhere, you can bring in other organizations, right? And to some degree, the GCP is doing this in gaming. And Entropy, who has been doing this as part of their mandate, the STEP team has been doing this. Let's find all of these different ways to increase demand for our resource, which is execution environments and block space, while simultaneously continuing to grow and capture more value. Does that sort of like answer your question?
It does. All right, I want to also get into now what the current, like what does the status quo look like in terms of the governance of Arbitrum and the different entities which are involved. Yeah. I think it maybe bears mentioning at the launch of the DAO, one thing that Arbitrum did very differently is give a much greater degree of ownership to the DAO than other organizations in crypto have. And I say this, I don't know if people are following along. I've got my Arbitrum swag on here. Blockworks was a delegate of Arbitrum from the TGE. So we've been, in the trenches and definitely big supporters. But yeah, I don't think people realize the degree of control that was handed over. It was pretty unprecedented, I would say, at the time, and even still.
It's still, no one's done it since. Yeah. I think some people might not have done it since because of some of the gray hairs on my head from getting it off the ground. But it's actually the bedrock of the vision, because none of this works if you can't look on chain and see that the residual owners of these things are Arbitrum token holders. Otherwise, it's a meme. And I think that's one of the challenges that we've historically seen, is that people don't understand the value proposition of what's happening. They think it's a meme. But when you give that ownership on day one, ever since the Arbitrum DAO launched, the outside of sort of even the Arbitrum Foundation, like the level of control over the Arbitrum Foundation that Arbitrum token holders has is incomparable in terms of that level of control that anybody else has. But like 3.5 billion tokens sitting in the on-chain treasury. Every dollar of transaction fee revenue, net of what's obviously paid to Ethereum, into the DAO's treasury. And the DAO has started deploying that. Last month, I think Entropy put up a proposal to take 7,500 ETH and to start investing it into DeFi applications on Chain Arbitrum. I think they're working with Fluid, Aave, Lido, Camelot, a bunch of others. All of that works. Like foundations can do this, but what happens is when foundations do this is they're just compounding and extending their mandate, runway, and treasury for them to continue to be that arm. They're not returning it into the DAO. I mean, they technically could, but there's no like legal obligation to do so. So all of this works and is a function of that at the genesis, Arbitrum doing this differently. And the state of the DAO, and interrupt me if I'm not fully answering your question. I think this is, but like course correct me if I'm not. Ever since then, I think Arbitrum's gone through like, and I should have said this in the beginning, but I'm going to definitely explicitly say it now. A lot of this, I think, is the responsibility and fault in many ways of Offchain Labs and the Arbitrum Foundation, in the sense that we were extremely hands-off over the last 2 years, allowing the DAO to form its own identity, its own mandates, its own missions, and sort of self-govern. And it's been healthy because you get incredible organizations like the Entropy guys. They're working full-time for Arbitrum now. They're ex-Bloxworks guys. They came out of this sort of whole kernel of experimentation of DAO ownership because there's no other ecosystem that allowed anyone to do that. If I did it again, we probably would have tried to find a better balance of doing this with Offchain Labs and the Arbitrum Foundation being in a position to sort of help steer the direction. But what's happened is I think we went through a few phases. The first 3 to 6 months of Arbitrum, there was basically gridlock because we went from top-down to control to like, what the hell should we do? Then there was, I would say, like the start of doing things in getting things done mode, but it was like a little more chaotic. And now things are working, things are happening. There's a ton of initiatives, but there's like operational inefficiencies associated with it. And I think that there's 2 components of this. And like the forum post sort of, goes into it a little bit that the foundation posted is you have right now there's too much demand on delegates in the sense that whether it's should we sponsor an event or should we turn on Time Boost, which is this like revolutionary new business line for the DAO that can introduce like A, B, and C consequences, delegates need to read everything. They need to vote on everything. And you get delegate fatigue. And what's I think been happening is a lot of the best stakeholders and inputs of feedback come from builders and people who care about Arbitrum because it's critical to their organization's success. And these people don't have the time to do all of this work, right? They need to be helped to make decisions. And we've seen that the delegates has, and these versions of delegates are absolutely critical, I think, to the success of Arbitrum, like L2B and others, but delegates are becoming these almost like, and Blockworks Research, for example, like these organizations that are like designed specifically to understand governance and understand the ramifications of decisions, but they're not like necessarily per se stakeholders in Arbitrum success. And I think we need to find a balance between those so that we're getting the advice and guidance and feedback from delegates, both on a governance perspective, but also from a product perspective. The way I think to solve this is to reduce the amount of decision-making that delegates must make. To me, the red line drops at delegates need to control the power of the purse in any system, because otherwise you run into a lot of the problems that I think we see in typical foundation structures. And 2, they need to maintain control of the protocol. Arbitrum should not be able to be upgraded without the token holders agreeing to. When I say Arbitrum, I mean Arbitrum 1, the tech stack. I mean the public blockchain governed by the DAO. And funds should not be able to leave the DAO's treasury without the token holders. But once that's happened, we need to introduce more operationally efficient structures to win, right? We're not going to get to this place where we're a digital version of Dubai without ruthless and relentless ability to execute. So that's what I think the role of OpCo is intended to sort of facilitate the introduction of, right? So we have OpCo, for those less familiar with the Arbitrum DAO. It's this newly formed entity. I actually was elected last week to join its committee of oversight. So I'm very excited to be in that role and sort of help the OAT, exactly, to get this off the ground. And the goal of that is to be this control panel that's responsive to the DAO and also has the ability to work with other Arbitrum entities who are contributing to make sure that they are doing their jobs to the best of their abilities to help Arbitrum succeed. And those organizations, Offchain Labs, Arbitrum Foundation, GCP, OpCo, Entropy, all of these different organizations, they need to have their mandate, their roles and responsibilities of what they're doing. They need to be accountable, both the token holders and the OpCo, to ensure that they're doing it properly. There need to be mechanisms and corporate governance to make sure that this can be successful. But they need to be able to operate ruthlessly to win. And I think what's happened historically is vendors, and I think Blockworks has done some of this work for the Arbitrum DAO as well, have been put in a decision tree where they need to make decisions that are either operational, strategic, or on behalf of the DAO. And that's not a place you should be putting vendors in, right? So Trail of Bits, for example, is the auditor of the Arbitrum protocol for Offchain Labs. Trail of Bits does not tell us when to launch a feature. They tell us, these are the risks, this is what needs to be fixed, and this is what you should do. If we ask Trail of Bits when should we launch it, it would be an unfair request. So I don't think that like this concept of having a lot of vendors contribute to Arbitrum is a bad thing. But what they need is to be reporting and have a scope of work from what we call an Arbitrum aligned entity instead of directly from delegates. Because now, instead of having one source of truth and one source of feedback, there's 100, which leads to gridlock, inefficiency, and frustration. So I think that's actually a really critical point. And the second critical point, and it goes back to the question you were asking about like Offchain Labs being a capital allocator, etc. There should be an embrace to have as many Arbitrum aligned entities as makes sense. So what I mean by that is, if you think about the GCP and what success looks like for them, it's very different than the Arbitrum Foundation, right? The Arbitrum Foundation is a steward that's supporting certain capacities, events, DevRel, grant programs, etc. They have certain KPIs they're supposed to hit, and that's like their role and responsibilities, and their employees should be compensated commensurate with those structures. If you have the GCP and you want to hire the best gaming fund investor talent, or we build a DeFi fund that's going to be doing that, their compensation structures should look different, because you want to attract the talent that is going to be doing specific roles and align those entity organizations to try and maximize what their KPIs are, right? And if you want to build a fund and you don't have carry, because these things don't work. So this is not like a club of like, these are the people that are running this. I want the DAO to think through and get business plans and think through its strategic goals and operate to find the best talent to do these things. And again, it's unique, it's ambitious. But I think if we want to get to this digital sovereign nation in a way that's ruthlessly effective and supportive of builders, of the communities, and compounding success, we need to make sure that we can operate as efficiently as possible.
Traders, AI enthusiasts, and degens, listen up. The game is changing, and Desk is leading the charge. To celebrate their launch, Desk is running a trading campaign with 3 major highlights. 38% of their token supply will be allocated to airdrops. They're offering the lowest trading fees on Earth, and finally, they will be running a Desk referral program. The more people you invite, the bigger your rewards will be. To get started, click the link in the show notes below and make sure to follow at Trade on Desk. This episode is brought to you by Morpho. Morpho is the first and only DeFi protocol Coinbase has integrated directly into their main app, giving millions of users access to borrow against their Bitcoin on Coinbase. Just as Web 2 companies like Google, Amazon, and Meta were built on internet protocols, the largest financial companies of the future, such as Coinbase, will build on decentralized protocols like Morpho. Whether you're an individual, fund, fintech, or institution, Morpho is for you. Follow the link in today's show notes to try Morpho today.
So I think that, and again, just for listeners who might be a little bit less familiar with the Arbitrum ecosystem, this list of like stakeholders. So there's obviously the foundation, there's Offchain Labs, and I heard you say it's product and engineering and that type of thing, and then Entropy, which as you mentioned, those are ex Blockworks guys, and I feel like they're kind of historically been almost project management and coordination a little bit, the introduction of strategic proposals, et cetera. So
Yep.
roughly. The GCP, which is the gaming fund, which seeded roughly around 200 million or 250 million ARB, I believe.
Yeah, I think it was 225, if I remember correctly.
225 to go bring and my memory as well, and maybe to do a little bit of a history lesson or talk about Blockworks' involvement here in the beginning is we also kind of saw, this was pre-Entropy obviously and the GCP, but saw there were multiple different stakeholders there that just needed a little bit of there needed to be more not like steering, just connective tissue and getting people on the same page, right? Like there's a huge amount of value to getting people on the same page. And that was actually the beginning of what we originally called the Arbitrum Coalition, which became the ARDC, which is still a structure that exists to this day. And then Entropy, I think, also was sort of involved in, trying to make things run a little bit more connectedly. And now I think this OpCo structure is sort of this.
This is the culmination of.
It's the culmination of a long series of, identifying this.
Yeah, and again, I think what's critical about the OpCo is it's responsive to the delegates.
Yeah,
and it's responsive to stakeholders. And I want the overlap of stakeholders and delegates to continue to converge. And this is about taking all of the feedback and all of the stakeholders and channeling it through a control panel that can then disseminate it to like world-class operators at what they're accomplishing.
Yeah.
And I think the OpCo is going to be such a 0 to 1 moment. Again, hopefully it's executed properly. If it's executed properly, and I'm so passionate about it, and that's why I joined the OAT. To me, it's absolutely critical as this like quarterback control panel to continue to understand all of the ambition. Because if you don't have, Arbitrum Foundation and Offchain Labs work very closely together, right? But if you don't have that connective tissue through GCP and other initiatives that are all responsive to the DAO, it's just going to be chaos, right? You need to have resources talking to each other. You need to have capital flowing, right? We need to get to a place where we can say this is a shift in strategic priority, and that is, who's picking it up? And I think the OpCo is going to be a critical player in managing all of this, again, in a way that's responsive to stakeholders, not in a way that's centralizing. And I think that's like an absolutely critical perspective.
One thing, I also draw an analogy here as well to DAOs that are like, I think there's an analogy here to be drawn to some of the older DAOs like Maker or currently Sky, and relatively close with some folks who are in that ecosystem. And actually, if you remember back in the day, there was a foundation at Maker, and then they dissolved. And there was actually a period of probably similar to when the analogy would be to when Offchain Labs and the foundation handed over, ceded an enormous treasury and complete ownership and control to the DAO. It's kind of like what comes next. And I've talked to a couple of people who are in that ecosystem. They said there's like this period of growth, right? And eventually now there's this sort of network of companies that contribute to Sky. There are stars that are spinning up. You kind of figure it out. And this is actually analogous to, there's a pretty famous hump around 50 people in a company as well, where you're whatever org structure you've set up to get from 0 to 50 completely breaks down. You have to rethink everything, and you spend more time thinking about how the company runs than actually the product that you're shipping. So it's very natural. One thing, it's a small thing, but I'm asking this question as I forget if I've ever told you this, but before Blockworks, I was in consulting and we specialized in procurement. One thing I think that it's always been a little bit challenging between the vendor DAO relationship is what the procurement process looks like and who your counterparty is.
Yes.
Actually, in the original scoping of the in the original scoping of the what became the ARDC, the reason there's an advocate role was actually me saying you need to be accountable to someone, right? Because if you're accountable to no one, you're accountable to everyone, and it's impossible to, you're serving not even two masters, right? You're serving many. And, I think one of the other challenges potentially the challenges go both ways. So there are lots of vendors out there who don't have the DAO's best interest at heart. They're like the looters of the DAO, right? And I totally understand why people are really sensitive to that, because there's lots of negative history of that being the case. The challenge from the vendor side of things is sometimes when you're trying to price a service towards people that have no idea how to price that service, and you're kind of selling towards someone that has no experience with procurement, right? So does this new structure, does it enable like easier counterparty?
Yes, the answer is that vendors are not going to be in this structure working directly for delegates. So let's say, for example, like I said, right, when Offchain Labs needs an audit, we don't ask the DAO to find an audit for the next version of Nitro. We have Trail of Bits has a contract with us to do it. If somebody, let's say the Arbitrum Foundation or Entropy, wants to run a grants program, they should run RFPs to figure out who are the best resources that can augment their in-house resources to make it the most effective program possible. They should design a scope of work, and that's the answer, right? And that's why a lot of vendors that I've spoken to about this, and the foundation has spoken to about this, they actually embrace this, because organizations, they need vendors, right? Like most companies use vendors for specific services that don't make sense to staff full time and are better with vendors. But the vendors look bad if they don't do a good job. The consumers, the purchasers of the services are frustrated if it's not done efficiently. So this is actually intended to be a mechanism to have more vendor participation where appropriate in the Arbitrum ecosystem, not less. And I hope that bears truth, because every time a vendor works, they'll be scoped and reporting to sort of an entity that is asking for their services, as opposed to the DAO itself.
It resonates deeply, and it's funny, like Jason, my co-founder, and Jason are in a co-CEO model, right? And even with the two of us, I mean, Jason and I lived together when we started Blockworks. We were friends before. I probably talked to him more than any human I've talked to my entire life at this point. So we're very in sync. But even reporting to two different people, right? Like sometimes Jason wanted one thing, I wanted the other thing. It causes confusion. Amplify that by 100. When a bunch of internet strangers and there are more people, right? So having one counterparty and even like a point of like that type of thing is so nice. It's so good from the vendor perspective as well. It's a massive improvement, I would say. It's just how DAOs work in general. So yeah, awesome. My 2 cents.
There you go.
Very supportive. Okay, one other thing I'm curious about as well is so let's talk about some of these. In our final kind of minutes here, I want people to understand some of the challenges so we've talked at kind of a high level of some of what the challenges that this solves, like the OpCo is kind of the connective tissue here, but let's talk about like the vendor selection and the RFP process is one, but let's talk about some other concrete operational improvements that you see coming out of this, so we can leave the people with something solid, and then let's end on kind of a high level. I'd just love to get your sense of like what's coming down the pipe in the next 12 months from Arbitrum.
Yeah, so operationally, again, I think there's two goals here. One is the mechanism of getting feedback from stakeholders, I think, has been broken in many ways because the demands on them are too high, right? Like the amount that you ask in Arbitrum of its delegates, and like the delegates who are involved are incredible. Like the amount that's asked of them is astronomical. And it doesn't need to be in order for Arbitrum to remain decentralized as an organization. We need to introduce operational efficiencies because I want more feedback. Offchain Labs wants feedback. GCP wants feedback from the people who will benefit or be hurt by decisions that are made from either a product perspective, an investment perspective, etc. Some of those people, some of the most important of those people, are just too busy to give it if it requires dozens of hours of work a week. I see it from builders all the time. I've asked people, get involved in Arbitrum now. They're like, it's too consuming. I've got my business that I need to run. So we need to figure out a way that we can be getting that feedback from delegates, investors, stakeholders in the most absolutely effective way possible, that will improve Arbitrum, right? Even things like debates about whether the GCP should be funded, debates about whether we should be deploying millions of dollars of ETH into DeFi to compound its growth and support builders. I want the most aligned Arbitrum stakeholders to be in those conversations. So if we can reduce the amount of decision making that they must make, we can get better guidance from them. So that to me is an absolutely mission critical thing that will come out of this. The second is, and it's sort of the thing that enables the first, is we have organizations that love Arbitrum and want it to win. Offchain Labs breathes Arbitrum. The Arbitrum Foundation does too. I've worked with the Entropy guys, GCP, everybody in the things that they are doing are focused on making sure they can do the best possible job for Arbitrum to win. We need these organizations to all work well together, to not have overlapping mandates. That's, I think, a key role in the OpCo. We need to think about how do we embrace more to bring on better human capital in specific verticals. Once we do that, once we have that ability, we are going to be able to execute and respond to the needs of our builders and our users much more effectively. Right? We're not going to be pulled in a million different directions. If we want to think about how do we help grow the DeFi category, what can we offer to early stage projects that we don't offer today to make them embrace Arbitrum? How can we do all of these things? When we have people who it's their authority, mandate, responsibility, and they have funding to do those things, the operational efficiencies will go through the roof. So that's what I really think will happen over the next 12 months. I want better feedback loops. Again, I'm going to reiterate because it's absolutely the most important thing. None of this works if the DAO doesn't become the ultimate source of authority. When I say the DAO, I mean they maintain control of the protocol and they maintain control of the power of the purse. But what they need to do is, and again, you need control structures. And if you read like the Arbitrum Foundation's bylaws and the GCP's bylaws, you can understand all of the thought process that goes into this. You need to let people build, have accountability to the people, to the token holders, whether directly or indirectly, whatever is most appropriate, usually indirectly through like a sub-board like GCP as a committee, and let them build and let them operate and let them execute. And the more that we can streamline this and build confidence in this vision, the better talent I think we will be able to attract. Because people who have endless opportunities, I'll just use this as an example. Like if we went down the path, and this is one that I would love for the DAO to explore, if we went down the path of thinking about how do we build somebody who can actively manage funds to deploy into DeFi, I want the best person in the world to do that. That person is not going to come and do that in a den of chaos because they have hundreds of opportunities that they can pursue. They can get capital from anywhere. That person will come when they have confidence. Again, it's not about not having control mechanisms to do whatever you want. Nobody has control mechanisms, even CEOs like you have a board still, right? Mm-hmm. There's all of these different control mechanisms that are in place to ensure that people are doing their jobs effectively. If people have those control mechanisms in place, we don't have to reinvent this just because ownership of Arbitrum is decentralized. What we need to do is allow them to streamline efficiency of working. And I think if we get all of this in place, we will be able to attract to our vision an immense amount of, opportunity and human capital.
I agree, man. AJ, this has been a ton of fun. And if there are people who are out there, organizations perhaps, or individuals that find this to be an appealing structure or want to learn more, or just want to figure out how they can contribute to the DAO and get involved in this vision, what's the best way for them to do that?
Great question. So OpCo is not stood up yet, which would be the answer once it's like stood up.
Yeah.
Please reach out to me in my capacity at Offchain Labs or my capacity on the OAT. The Arbitrum Foundation is a great resource, but you can find me, Arbitrum Foundation. And as we're all building to get this OpCo stood up on behalf of the DAO, I think that, I would love to speak with anybody who wants to get involved.
Awesome. And we don't want to volunteer him without his permission, but I saw Patrick McCory made it on there as well. So
yes, Patrick. Yeah. And then Frisson from Tally is sort of the OAT. And then we have a mandate to add 2 additional members
Nice.
As well. So we're going to be convening soon to start thinking about how to best find complementary folks.
Excellent, sir. All right, AJ, it's been a pleasure as always chatting.
Awesome.
I'll have to do it again soon, my friend.
Thank you so much. Yeah, this was great. Appreciate it.
Take care.